Good afternoon. This is Xavier Daly with Daley and Paulk, and today we're going to be going over dollar yields, bonds, housing, and this is just going to be another one of our weekly market updates, just looking at how the market's doing. Honestly, let's just dive right on in. So, starting with the dollar, let's reset this chart view. The last week, the dollar's momentum has been going further down. So it looks like last week we were having some strengthening. We're right back to where we were last week, and looks like the momentum is going down. And just to remember, why do we even look at this? Okay, it's because if assets are priced in dollars, okay, and the dollar goes down, if all else is equal, the price of the asset is going to go up because the dollar it devalued. Okay, so if the numerator stays the same and the denominator goes down, the absolute value is going to go up. Okay, and it looks like dollars weakened a little bit. Dollars got weaker, and let's see how that impacts the market. So it looks like 10-year yields also went up. Usually dollars and yields they follow together, meaning if yields go down, yeah, let's go back to dollar. If dollar goes down, yields are going to go down as well. But it looks like, at least in the very short term, if you see on the right hand corner, you guys probably can't see that. Just on Friday, they both went up at the same time. But for the weekly chart, it looks like, oh, on the weekly chart, yields were down as well. So look at this pattern that we're having in yields, okay? Look at that. It looks like it's consolidating into some type of like a falling wedge. And let's look at what some of these falling wedge patterns are, just to give you an idea on what I'm talking about. Okay, so a falling wedge is whenever it squeezes lower and lower and lower, lower bottoms and even lower tops, and then it breaks to the upside. So it looks like a rising trend, downtrend as a correction, and then a rising trend again. Rising trend, just a consolidation, and we're gonna break out higher. So if it looks like the chart says that yields are gonna go up, okay. If yields are gonna go up, we can probably infer that inflation is gonna chase yields, okay. Or actually, yields are gonna chase inflation, so inflation is probably gonna go higher. If we're having a lower dollar and it looks like yields are in a consolidation pattern to the upside, we can make the guess that it looks like inflation is going to go up. So if we know that yields, at least yields for the on the short term have been kind of lower, we would expect bond prices to at least, let me take off all of these pictures. We would expect bond prices to at least go up, and that's what it looks like bond prices are doing. So if we just go on like the monthly chart pattern, it looks like bond prices have been going up. So bonds are looking, they're not looking garbage now anymore, okay? Bonds are actually looking decent. On the longer term pattern, they still look garbage. I wouldn't even touch bonds. Guys, look at this chart. Those are bonds, right? Let's just look at gold priced in bonds. We're gonna do gold relative to bonds. Okay. Shiny metals relative to bonds. Okay. Shiny metals are absolutely destroying bond prices. You can't default on shiny metals. Okay. You can default on government bonds. And if you don't believe me, just let's just wait until the future. Okay. And the default with bonds, that doesn't look like the government not being able to pay its debt obligations, because the government's always going to be able to pay their debt obligations. They print money. What it looks like is they end up debasing the currency by so much that the bonds cash flows become worthless. That's what a monetary default looks like with government treasuries. But on the near term, it does look like bond prices are strengthening to the upside a little bit. Let's see how much more they strengthen. Now, housing starts. This actually does get me extremely worried, okay? So, if we look on this right hand side corner over here, housing starts data did release for this month, and we were actually down almost 8%. So, the expectation was around like 1.3 million in housing starts, like somewhere over here. We actually contracted once again to 1.31 million. And, oh, one second. Let me try and fix. Oh my gosh. Let me try and fix this a little bit so you can see. All right, whatever. I'm not going to touch anything else. But housing starts are contracting. All right. Housing starts ever since 2020. It looks like we are in this downtrend, and it looks like we're breaking at the same point that we were during February 2020. Can a recession happen? Okay, I think it's actually pretty probable now, if I'm being quite honest. When you see housing starts contract, you see bond prices start to go up, and then you see the dollar look like it's a little volatile and yields breaking to the upside. It does look like um, there could be a recession in the markets, because what happens is whenever housing activity contracts, remember, they build houses and new loans are put on those houses that end up causing inflation. If the opposite were to happen, whenever housing starts breaks these long-term trend lines, like let's say there's clearly like a bunch of there's a mode or like an average number in this area. Whenever housing starts breaks somewhere along this line, uh, housing the monetary the money creation from housing starts to contract. So it's a deleveraging event, and that causes recessions in the market. Deleveraging events in the market can cause recessions, and yeah, this just isn't good. This isn't good because every time we break one of these long-term downtrend lines, we get a recession. And I'm gonna go to Fred housing starts. Okay, this is the this is our central bank's data from the government. Okay, every time we end up going lower and breaking that long-term occupancy line, we end up having a recession. Besides 2000, the early 2000s, because that was a dot-com bubble that ended up crashing. But there was also it was also the beginning of that. There was a small housing bubble here as well. I'm not gonna get into it today, but there was a small housing bubble here. Obviously, the great financial crisis, like housing starts just fell off of a freaking cliff. There was a crash there, and COVID. There was a housing starts crash there. Now I think we may have another one. Okay, if I had to expect, we may have another housing starts crash over here. And a reminder, like I said in my last video, this area over here reminds me of this area over here, where we had a big breakout and then a retest. Where in that retest we had a recession, big breakout from 1995 to let's say 2000. Big breakout of the average occupancy. We did a retest, recession, and then like we start to take off. I think we're in the same type of environment right now, and I do expect us to probably have a recession. Gold is absolutely taking off, ladies and gentlemen. Look at this chart. That thing's beautiful. Look at that. Just look at that. You throw this baby on logarithmic. Look at that, guys. This the commodities bull market's starting. Okay, we're gonna run up some 1970s type moves. Okay, and you just have to be in it, or you're just gonna be out of it. Like it's just as simple as that. It's as simple as that. Look at where we are for the year. Gold's up 60% for the year. Okay, these shiny metals are up 60% for the year. What are you gonna do? Just hop in, just ride the train, just buy these physical metals and just hold and don't do anything. Okay, it's as simple as that. Now, on the most recent term, okay, we did have this big bullish engulfing. This wouldn't be a bullish engulfing, but this is a bearish candlestick, so it looks like where's the marker? It looks like we could maybe go lower and then maybe like consolidate into like some type of pattern that ends up like breaking to the upside. That's what I expect. Just kind of like how we did over here. We went into a little consolidation pattern and then we broke up to the upside. We could just be doing the same thing, just a stair stepping pattern to the upside. But I don't know. I don't know what's going to happen to gold. I don't know where gold's going to go. But what I do know is that like the smart thing to do is just to be in it and just hold and just ride this wave. Silver's having pretty much the same pattern. Now this is a bullish engulfing. So honestly, I honestly would expect silver to probably go down, do some consolidating, and before a big breakout. Because guys, look, we're closing above all-time highs. That means throughout all of history, we've never been at these price levels. Okay, we're entering uncharted territory. Okay, and this is why you just gotta be in it. You just gotta be in it. Look at this cup and handles pattern, guys. This is a 200-year cup and handles pattern, and I'm just gonna show you what this looks like. A cup and handles pattern, guys. This is where we are. Okay, this is just a fractal of what's to come in the future. We're gonna go way higher, way higher. I think three, four, $500 higher. Okay, because in technical analysis, if you can measure the base of the cup and then see how long the extension would be, and that brings us up. That brings us up to like some pretty ludicrous numbers. Okay, but anyways, silver's breaking all-time highs. Right now, we're having some bearish candlesticks. We may have like overextended in the near-term future. It's gonna retest probably to somewhere around $48. Could retest to somewhere around 30 something dollars, but it's gonna go a lot higher. Okay, it's gonna go way higher. And for the year, it looks like guys, it's silver's up almost 70% for the year. Okay, it probably is gonna do a retest. It's kind of overdue. But what do you do at the retest? You buy. You buy the retest. Then you just hold, and then you just wait for silver to get 100, 200, $300 an ounce, and it's gonna be a fun ride. I'm actually gonna immediately after this video, I'm gonna show you like a little presentation about silver, some of the silver companies that I'm looking at, and why I'm invested into them, and I'm gonna be really excited to see you in those comment sections telling me what silver stocks you're buying. Platinum. Platinum's having another one of those bearish engulfings. It looks like a lot of the commodities are doing a retest, which is perfectly fine. That's perfectly normal in the market. Whenever you break these long-term trend lines, you should expect to have a retest and then a recovery where it breaks out. Okay, so I'm just gonna show you retest, breakout. You have resistance, you break out, and then you do a retest before you end up continuing on that move. So, platinum down a little bit, still looks pretty good. Oil, oil does not look good. Okay, if I'm being completely honest, based on housing starts in gold and silver, it looks like we're having a contraction in the business cycle. Okay, the real estate cycle is the business cycle. The business cycle is contracting. Oil, gold, and silver are already breaking all-time highs. Which means it shows that there's a lot of fear in the markets. Okay, we could be having a deleveraging event, a contraction in economic activity, and oil almost will certainly uh, go down during a contraction in the business cycle. Now, in my opinion, after this is over, it's going to be a slingshot pattern. So it's going to be a retest, a breakout, and then a slingshot. Okay, this is the first leg. This is the second leg. We're gonna break this pattern. Okay, we're probably gonna go. Where's the marker at? We're gonna break this pattern. Probably gonna go into the mid 40s for just a little while. I don't know how long, but for a little while we may reach the mid 40s. Oh my gosh! But we're gonna break out, and then we're just gonna rip. We're gonna have that second leg where it goes way over the all-time highs. It's gonna start chasing silver and gold and all the other commodities because all the commodities go up the same. Okay, if you think oil is just gonna lag behind while gold and silver enter the bull market, you're stupid. That's never happened before in history. Okay, all the commodities move up together. So why would oil be the last one standing? Why would oil not be invited to party? Why would oil not be invited to the party when oil's the one that's hosting the party? That doesn't make any sense, okay? So oil is looking pretty weak right now. It's not going to be looking weak forever. We could break down, maybe go into the mid 40s before going a lot higher. But I mean, we're just going to wait and see. And those in the channel, those are who are subscribed and have been looking at some of the stock picks that I've been giving out on my Instagram channel. Link in the description. You're going to be making a lot of money, okay? Next, oil to gold ratio. Oil to gold ratio is still at all-time lows. We're at the same valuations we were during April 2020 during the COVID pandemic. And guys, the reason why the ratio is so low is because gold has outperformed oil by so many orders of magnitude historically that it's just in like uncharted territory at this point. Okay, During the last 5 years, oil's pretty much gone nowhere, while gold's like doubled, almost tripled in value. So that's how you get like a complete debasement of oil relative to gold. Whenever this does mean revert, the system could break. Okay, if the oil to gold relationship just mean reverts, let's say it just goes back to like point 0.4. Okay, and gold stays the same. That means there's like a 4 times revaluation of oil relative to gold, and gold's gonna stay the same. Okay, but that doesn't happen. Whenever this ratio goes up, all right, where's my marker again? Whenever this ratio goes up, that doesn't mean that like because there's U.S. oil to gold. Okay, the ratio is going to go up with gold going up, but oil going up a lot more. That's how this ratio is going to go up. We're not going to enter a gold and silver bull market and have the oil to gold ratio go up because gold went down. That doesn't make any sense. It's going to be because oil is going to outperform gold by many more magnitudes than it has recently historically. Okay, because there's these little trend lines that are over here, and it looks like a megaphone pattern, honestly. Uh, but we're at the very bottom. We're at the very bottom of this downwards megaphone pattern. Exactly like this. Exactly like this. It's a downwards megaphone pattern where whatever it breaks, this is a bullish pattern, by the way, because if it breaks the downwards megaphone pattern, it's going to rip. It's just gonna rip. So, yeah, I mean, oil, it looks pretty bad in the short term, but on the long term, this looks absolutely amazing. Absolutely amazing. Retail stocks. Last time we looked at the market, we were having these big, massive bearish engulfings, and recently we've just been going sideways, which makes me believe this is going to go down because whenever you have like these little sideways moves, where's the marker? You got these sideways moves, then it's just gonna probably dive lower. This is just it's just a flag. It's gonna break lower. S&P 500. It doesn't look too bad, but it doesn't look that bullish because these green candlesticks they weren't really competing with this big red candlestick. Okay, the big green candlesticks weren't that green compared to the big red candlesticks, which makes me believe this is a continuation pattern to the downside. SOX, which is semiconductors ETF, same thing. Big downwards candlestick last week, and then like a bunch of small green candlesticks, but they end up gapping up higher. Guys, we're in an AI bubble, okay? I don't know what else to tell you. I don't know what else to tell you. Look at Nvidia's. How much is Nvidia worth? Guys, it's a $4.45 trillion industry. Guys, Nvidia alone is worth more than the entire oil and gas and the uranium sector combined, okay? Nvidia alone is worth more than the entire gold and silver mining company industry combined. Just think about that. We're in an AI bubble, and this is just an extension of it. This is going to go sideways. It's probably going to look something like this. It's probably going to look something like this, where it's going to go lower and then higher and higher, and it's probably going to break out, and it's probably just going to go a lot back lower. Guys, we're probably done with this AI bubble if interest rates are going to start breaking to the upside. Because remember, the cost of money is increasing. Look, U.S. government bonds are going sideways. It looks like it's a wedge pattern. It's going to break to the upside, which means money is going to get more expensive, which means inflation is going to go up. Okay, because this is investor psychology on inflation expectations. So inflation goes up and money becomes more expensive. What do you think is going to happen with all of these super not very profitable technology companies? Okay, they're going to go down. They're going to get revalued. They're going to get repriced, and SOX is just waiting for that to happen. Bitcoin, Bitcoin doesn't look the best. I mean, it looks solid. There's a lot of momentum behind it from 2023 to where we are right now. Like this is just a massive, massive bull market. It went from 16,000 from 2022 all the way to 109,000. it went up 5x in 2 years. It's pretty ridiculous if I'm being quite honest. And Bitcoin has what looks like a $2.1 trillion market cap. Yeah. So Bitcoin, the momentum's still there. It can go a lot higher if I'm being quite honest. It also could roll over. Honestly, I don't have too much into Bitcoin, so it really doesn't even matter to me. It's just to diversify and hedge against the fiat currencies. Um, but I wouldn't be surprised if Bitcoin went up higher. Ethereum, Ethereum, kind of the same thing since April 25. There's a lot of momentum behind Ethereum. Yeah, there's a lot of momentum behind Ethereum. Uh, these are some smaller red candlesticks, but look at these green candlesticks that came before it. And these are weekly charts. I mean, up 38% in a week, up 15. Like, it's probably gonna go a lot higher. Okay, it's probably gonna keep on going up. The dry bulk index is it's about to break out of this pattern. Right now, it's around $2,000 an index. This is gonna go a lot higher. One chart I really like to look at is the dry bulk index relative to gold, because during commodity boom markets, at least the last one, the dry bulk index outperformed gold. So where was it? So like yeah, from 2000 to 2008, it was just in a totally different paradigm. Ever since the great financial crisis, absolutely killed the dry bulk industry relative to gold. So if we just enter like a mean reversion of this and gold goes up, the same chart I showed you as oil, the dry bulk index is going to do very, very, very well. Okay. M2 money supply just continuing to go on up 80 billion for the month. Yeah, this is a monthly candlestick, up 80 billion for the month. And like we talked about last time, the Fed's balance sheet went up $500 billion for the month of September. So next month we're going to get more data on how big our central bank's balance sheet is, how much government bonds they've been buying, and and yeah, we'll see what's going on there. Uh, but what I'm seeing in the market right now, it looks like there's a lot of fear in the market. It looks like we may have a recession. Okay, stocks are looking really choppy. Gold and silver are breaking all-time highs. Yields are going up, and housing, which is the business cycle, looks to be contracting. So based on the data that I'm looking at, we may have a recession. We may not. What would be the smart thing to do? What would a good investor do? A good investor would just invest into undervalued assets and just hold for a long time. So I would say the commodities still, gold, silver, and oil, seem to be the best hedges and the best bets for today's market. Uh, this is Xavier. I'm glad that you're watching another video. Make sure you like, comment, subscribe below, and I'll see you later. Peace.